Welcome back to EPK Capital's YouTube channel. Today, we're diving deep into one of India's most iconic consumer goods companies, Dabur India. With over 138 years of heritage and a current market cap of 91,851 crore rupees, this Ayurvedic giant has been a household name for generations. But here's the million rupee question. After falling 21% in the past year, is Dabur stock a hidden gem or a value trap? Stick around as we unpack everything from their century-old legacy to their modern financial health, technical charts, and whether Benjamin Graham himself would approve of this investment today. Let's start with the fascinating story of Dabur India. Picture this, it's 1884, and Dr. S.K. Burman, an Ayurvedic practitioner, is selling medicines on a bicycle in the bylanes of Calcutta. His patients started calling him and his medicines, Dabur, a combination of Daktar, doctor, and Burman. From those humble beginnings, Dabur has grown into one of India's largest FMCG companies with operations in over 120 countries. The company is still controlled by the Burman family, who are the promoters holding approximately 66.2% of the company. The current leadership includes Anand C. Burman as chairman, representing the fifth generation of the founding family. What's remarkable is how they've managed to transform from a family-run business into a professionally managed enterprise while maintaining their Ayurvedic roots. Under the Burman family's stewardship, Dabur has evolved from a small medicine manufacturer to a diversified consumer goods powerhouse with brands like Dabur Chyawanprash, Real Juice, Vatika, and Fem. The company's strategy of marrying traditional Ayurvedic knowledge with modern science has been the key differentiator in the crowded FMCG space. 10-year financial analysis. Now, let's crunch the numbers and see how Dabur has performed financially over the past decade. Looking at their revenue growth, the company has delivered a solid 5-year CAGR of 9.32%. Revenue has grown from 8,685 crore rupees in FY 2021 to 12,404 crore rupees in FY 2025. However, here's where things get interesting. While revenues have grown, profitability margins have been under pressure. The net profit margin has declined from 16% in FY 2021 to 11.98% in FY 2025. This margin compression is primarily due to inflation in raw material costs and increased competition in the FMCG space. Let's talk about the company's financial health. Dabur maintains excellent liquidity with a current ratio of 2.01 and quick ratio of 1.20. The company has more cash than debt, with total cash of 26.56 billion rupees against total debt of 9.5 billion rupees. Their debt-to-equity ratio stands at a comfortable 8.48%, making them one of the most financially stable companies in the FMCG sector. The return on capital employed, ROCE, has seen some decline from 27.56% in FY 2021 to 21.47% in FY 2025, but it still remains healthy and above industry averages. Earnings per share has been relatively flat, moving from 9 rupees and 58 paise in FY 2021 to 9 rupees and 97 paise in FY 2025. Stock chart technical analysis. Moving to the technical picture, Dabur's stock has had quite a journey over the past decade. The stock has delivered an 87.1% return over 10 years, but recent performance has been challenging. The stock hit an all-time high of 672 rupees in September 2024 but has since corrected to current levels around 514 rupees. Looking at key technical levels, the stock is currently trading below its 52-week high of 671 rupees and 50 paise and above its 52-week low of 433 rupees and 30 paise. The RSI is currently at 40.34, indicating the stock is approaching oversold territory. Multiple technical indicators like MACD show bearish signals, while the stock trades above its 200-day moving average, indicating long-term bullish trend intact. Key resistance levels to watch are around 530,560 rupees, while support levels are positioned at 480,500 rupees. The stock's beta of 0.25 suggests it's less volatile than the broader market, making it suitable for conservative investors seeking stability. Benjamin Graham valuation. Now for the value investing perspective, would Benjamin Graham approve of Dabur at current prices? Let's apply his famous formula. With an EPS of 9 rupees and 97 paise and book value per share of 60 rupees and 94 paise, we can calculate the Graham number. Using Graham's formula, square root 22.5 times EPS times book value per share, we get square root 22.5 times 9.97 times 60.94 equals square root 13,664 equals 117 rupees. This suggests the intrinsic value is around 117 rupees, while the stock trades at 514 rupees, indicating significant overvaluation by Graham's conservative standards. However, it's important to note that Graham's formula was designed for industrial companies in a different era. For a quality consumer goods company like Dabur with strong brands and consistent cash flows, a premium to Graham's calculated value isn't unusual. The company's PB ratio of 8.19 is close to its 10-year low, suggesting relative value despite the absolute overvaluation. Pros versus cons, bull case versus bear case. Let's examine both sides of the investment thesis. Starting with the bull case, Dabur has several compelling strengths. First, they dominate the Ayurvedic and natural products space, which is experiencing strong secular growth as consumers become more health conscious. The company holds leadership positions in categories like Chyawanprash, honey, and juices. Their international business, contributing 26.5% of revenues, is showing robust growth of 17.2% in constant currency terms. This geographic diversification reduces dependence on the domestic market and provides growth opportunities. The company's strong balance sheet with net cash position gives them flexibility to invest in growth and weather economic storms. The recent acquisition of Badshah Masala for 588 crore rupees has strengthened their position in the fast-growing spices segment. Management expects to double their food and beverages business to 4,000 crore rupees over the next 5 years. Now for the bear case, margin pressures are a significant concern. Operating margins have compressed from 20.6% to 19.32% over 5 years due to commodity inflation and competitive pressures. The domestic FMCG market is increasingly competitive, with MNC players aggressively pricing their products. Rural demand, which accounts for about 50% of Dabur's sales, has been subdued due to various economic factors. The company's premium valuation at over 51 times earnings leaves little room for error. Currency headwinds in international markets also pose challenges to profitability. Important checks, controversies, and global position. Let's address the elephant in the room: recent controversy surrounding Dabur. In 2023, the company received a significant GST notice worth 321 rupees crores, which they're contesting. More concerning are the lawsuits in the US and Canada, where Dabur's subsidiaries face allegations that their hair relaxer products may cause cancer. While the company maintains these allegations are based on unsubstantiated and incomplete studies, litigation costs are expected to be material. Additionally, there's been controversy surrounding the promoter Berman family's attempt to acquire Reliq Air Enterprises, with allegations of corporate governance issues, though this doesn't directly impact Dabur's operations. On the positive side, Dabur's global positioning remains strong. The company operates in 120-plus countries with manufacturing presence across 8 countries. They're leaders in several categories across key international markets like Saudi Arabia, Egypt, and UAE. The Middle East and Africa account for 26% of their international business, with Asia contributing 22%. Conclusion. So, where does this leave us with Dabur India? This is a classic example of a quality company facing cyclical headwinds. The company has strong fundamentals, dominant market positions, healthy balance sheet, growing international presence, and exposure to the secular trend toward natural and Ayurvedic products. However, the current challenges are real margin pressures, competitive intensity, rural demand slowdown, and rich valuations. At current prices, the stock appears to be pricing in perfection, leaving little margin of safety for value-conscious investors. For long-term investors who believe in the Ayurvedic and natural products story, Dabur could be attractive on any significant correction below 450,470 rupees levels. For those seeking immediate returns, the next few quarters will be crucial to watch. Any signs of margin recovery and rural demand revival could trigger a re-rating. Disclaimer: this analysis is for educational purposes only and should not be considered as investment advice. Stock prices can be volatile and past performance doesn't guarantee future results. Please consult with a qualified financial advisor and do your own research before making any investment decisions. The information presented here is based on publicly available data and our analysis, but market conditions can change rapidly. Remember to like this video if it helped you understand Dabur better, subscribe for more stock analyses, and let us know in the comments which stock you'd like us to cover next.